Welcome to the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. And I have to mention, this podcast is sponsored by Vanguard. Big fan of Vanguard. Let's get to our featured interview for this episode. Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Good to see you in person for a change. Every day I'm reading your notes, Callie. Every day you're reading this stuff.
Yeah, well, we're thinking about a lot over at Ritholtz, and it's great to be here.
Yeah,
Excited to chat.
It's good to see you here. And now markets are back in rally mode, just like that. Should investors be, I guess, enthused? I think if you talk to investors in early April after Liberation Day, they thought the world was going to end. Sit here today, it's a little bit of a different story, at least in the eyes of the market.
Yeah, and I think that's a reflection of expectations, Brian. I always tell people the recipe for the market is expectations and reality, right? And for so long in 23 and 24, low expectations, pretty good reality. That's enough to get a pleasant surprise in these relief rallies like we're seeing today. And when I say relief rally, I just mean, people breathing a sigh of relief and, buying stocks because things aren't so bad. Right now, our expectations are lower, and I say our, like the royal we, the world.
Whoever that we is, they're just out there somewhere.
Right. Expectations are lower, everybody is braced for the punch, and every little bit of good news feels like relief in the desert, and you get that relief rally.
I think you and I are going to sing from the same hymn sheet today. I hope I have that right. The elephant in the room, you wrote this, is earnings expectations. The market, investors are still looking for double-digit earnings growth. Why? I talked to a lot of CEOs. I talked to, most recently, Coca-Cola CEO and Chairman James Quincy. He told me, Brian, consumer demand is weakening. We're going to hold firm on prices for now. I don't want to hear Coca-Cola CEO telling me that demand for soda is starting to weaken. Not a good sign. Yet we have earnings expectations for this year up double digits. Help me understand the disconnect here.
Well, I'm sorting through the same thing. I'm looking at the data and asking myself why, because I'm hearing the same thing as you are. Companies and CEOs coming out and saying, this is a material change to our costs. We're going to try and pass it on to the consumer. I'm surprised at how many companies are saying that. I thought that there would be less of a push to do that because I'm not sure the consumer will respond and actually pay those prices. But we are seeing companies coming out saying that they can pass costs along. Maybe that's the reason why we're seeing expectations high, but Wall Street is planning for the best year since 2021, and before that, I believe 2018. Expectations are quite high here, and they're especially high on the tech side. Tech is exposed to tariffs, both on the cost of goods side and the international revenue side. So I am also asking what gives. I think analysts are frozen in their tracks.
You wouldn't pay $8 for a 2-liter bottle of soda? Maybe that's where we're going here.
Yeah, that might be the world that we're living in, and these are questions that are going to have to cross our minds. And I mean, if you ask it that way, you can understand why you'd think consumers may balk at that, and maybe look at other products that other companies aren't necessarily jacking up the costs on.
Sneakers could be going up double digits. I remember before the trade war, Callie, I think it was the CEO of Brooks told me, he's like, we could see, if tariffs go through, we could see product prices go up 50%. So what does a sneaker go from $100 to $250 or $200? That's crazy.
Well,
that has to hit demand.
I hadn't heard that, but I wear Brooks to run, so now.
Well,
now
I'm telling you. See, this I'm giving you news you can use. This is what's coming at us here.
Yeah, and I don't think you and I and many Americans have really processed what this could mean because we haven't seen it happen yet. We still have shipping volumes dropping, but that means that the ships from China and overseas are coming into the ports and port volume is dropping. Those goods are not on our shelves yet.
So should investors ignore these earnings estimates?
I don't think ignore is the right word. I think you need to take in some context with them. And what I mean by that is, watch the numbers, watch the, EPS earnings beats, the revenue beats that we get. And beats are coming across the tape like they usually are.
I'm so surprised.
Well, this is the first quarter, right? You got to remember Liberation Day happened on April 2nd. Second quarter technically. So I think you have to take all the data in, but you have to listen to the management commentary extra carefully this time around. And I would say that every quarter, by the way, I think management commentary is the most important and most valuable part of earnings season. But you have to listen to what they think about tariffs, what they expect for the future, how they're projecting costs. And the point that you brought up from the Brooks CEO is a golden line that you should listen for in every earnings call. How are we planning on absorbing these costs? Can we pass it on to the consumer? Because that matters for your wallet and it matters for your portfolio.
No, and of course, a shameless plug here. Shout out to the Yahoo Finance team. You can now listen to live earnings calls on the Yahoo Finance platform. That's where I listen to Starbucks' earnings call right on our platform. It's so easy. You just go to the ticker page and you just pull it up and you can listen to the call. So I had to do that. Like, it's just, I mean, I love this function. So is it realistic that the first quarter, the results we're getting now, this is just the best for the year? And that maybe the second quarter, third quarter, and fourth quarter, we see S&P 500 companies overall reporting down earnings year over year?
I worry about that. So again, if you go back to estimates, and when we say estimates, we're talking about all of the sell side analysts on Wall Street getting together, talking to management of the companies they cover, and putting together these estimates for their companies, and adding those together.
I hate
in a very
that's a different discussion. I hate the whole process.
Oh, don't get me started on that.
It's awful.
But yeah, there's a lot we could say there. But it's a bird's eye view of a bunch of different estimates. And right now, all those estimates put together show that earnings could level off in the second and third quarters, but come back in the fourth quarter. I hope that's the case. I want markets to stay afloat. I want the economy to stay afloat. I want this to be less of an event that a lot of people think it will be. I'm not as optimistic about that. And I think what worries a lot of people on Wall Street is that it feels like the worst is to come, and we're kind of whistling past the graveyard here. You
know what I find also fascinating is, so in analysts, they see earnings up double digits this year. And the S&P 500 is now at trading at, I think, 20 times forward earnings on a PE basis. If you go back to look at past recessions, in some cases, the PE ratio was under 10 times. And I'm not saying we're going back to trade at like 9 times as we did during the great financial crisis, but 20 times in this environment seems high. Like, why is that multiple still so high?
I try to put a lot of caveats around the multiple because I think too often investors look at the PE, especially the forward PE, which is what I would do. That's future earnings or earnings estimates instead of past earnings. But I think too often investors look at the PE and they say, okay, the PE is X, 20. That seems too high because it should be 16 or so. That's really hard to judge because there's an element of hope and expectations in there. We keep coming back to expectations, expectations versus reality. I think valuation definitely matters in this environment because we're at a point where expectations and reality are changing. The PE should be somewhere, but probably not 20. I think it's hard to say where it should be, especially if you're looking back at past crises, because the world looked different. Tech was at 40% of the S&P 500. Back in the great financial crisis, iPhones were still like an early on product. COVID happened under different circumstances, and I'm not trying to say this time is different, but I think it's so hard to judge a market solely on PE. So I'm a little hesitant about adding too much value there.
So if one is a believer in this bounce back we've seen post-Liberation Day, where do they go?
Well,
sector-wise?
I think this depends on your time frame. That's a really lame answer, but if you're a trader, if you're looking at days and weeks, if you're opening a position and planning to close it out, I don't know, next Wednesday, then I think you look at what's been sold off hard, and that's tech, that's small caps, that's more growth names. That's typically what we see in sell-offs, by the way. What does really well on the way up gets hit hard on the way down. And typically, if you do see these, relief rallies, we go back to that phrase, you see them happen concentrated in the names that were hit really hard. If you're a long-term investor, like the clients we serve at Ritholtz, I think you need to protect your sanity here. You need to stick to your plan, and what that means is you need to, remember why you're investing, when you need that money, and what return you need over the years and decades you're investing, and that will dictate where you put your money now.
I imagine you, of course, like you just mentioned, work with a lot of long-term investors. Why are long-term investors just so, they continue to be in love with the Mag 7? They did love these 7 stocks, and if you ask them, why do you love these stocks? Oh, it's the AI. They don't know anything that these companies are actually doing. And I'm not just trashing the retail investor in some cases, but I just feel as though they don't really know the individual stories of these companies.
Well, look, I get it. AI is a really compelling story, and it's cool that it's at our fingertips now. I find it so funny that AI has been in the talk for decades. I feel like I was looking at this for a note a while ago, but there were mentions of AI going back to the 1950s. But now it's in our hands. We have ChatGPT, we have Claude, we have Gemini. The technology is tangible.
We've got Tesla bots.
We've got Tesla bots.
Those are cool.
Yeah, but we have these applications to our daily lives, and I think for a lot of investors, they see it happening, and they know the companies that have been talking about it a lot, that are trying to get to the forefront of this story. And obviously, it's the Magnificent Seven. I mean, Nvidia, for example, has been a hot stock for us for a while. But America hadn't been talking about it for very long.
Nobody knew what Nvidia did. And look, I tell a story too. I worked with a mentor of my friend Jim Cramer at the Street, and I never heard of Nvidia until maybe 2017 or 2018. Jim would come in the office and talk about Nvidia. I mean, Jim was so far ahead of this call, and now the whole world loves Nvidia.
Yeah. So it's funny to see the world come along, and I understand why AI is drawing people to the Mag 7. But you're right. No company has really, other than Nvidia and probably a few semiconductors, no company has really grasped AI. Like Apple executives, Google executives.
Where's Apple's AI?
Well, that's the big question.
Are we using Apple Intelligence? I'm not even using this at all.
I mean, no, they're behind. And I think they've publicly said they're behind. But you have to remember, Apple, at its heart, how it makes money, it's a hardware company. And you have to ground yourself in that, especially in times like these when there isn't a lot of expectations, hopes, and dreams being priced into markets.
So true. All right, Callie, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid. Welcome back to Opening Bid here at the NASDAQ in Times Square. And of course, Opening Bid sponsored by our friends at Vanguard. Having a great conversation with Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Over the past month of this, borderline chaos in markets, I've had more conversations about the bond market than I ever had in my career. Not that I ignore it, but the bond market's out there. You look at it and maybe write a story on housing or something. But I'm asking everyone if we are headed towards a crisis. And I put this question to an episode I did with Double Line's Deputy CIO Jeffrey Sherman. I see more debt coming in the back half of the year, potentially from a Trump tax plan. I see the economy weakening. Like, what are these things? What could they mean to the bond market?
Well, it's funny. I totally agree with what you say. We don't talk about the bond. So we watch the bond market over at Ritholtz. Of course, we have a vast majority, if not all of our clients invested in some sort of fixed income. But the bond market doesn't matter until it matters, and then it really matters. You feel it, right?
You're following the 10-year on Yahoo Finance. Ooh, 4%, 4.3, oh, 5, oh shit. Like, whoa, not good.
Yeah, and more tangibly how it works in your portfolio, because people invest in it for the portfolio cushion, right? They want to be braced against losses. That's something that a lot of investors strive for, even if they don't admit it. And when the bond market isn't working there, you feel it. You see it in your portfolio value, and it hits you right in your gut. So are we heading for a crisis? I don't think it's that simple. Is anything ever that simple?
Nope.
But I do worry about the U.S. exceptionalism trade and how that's slowly unwinding, because I'm not sure people realize how ingrained foreign investors are in our markets and how pissed off they are right now and how much power they hold.
What would that mean? And you're not the first person. I've heard this in the past 2 weeks. If foreign investors start selling, even if it's in small increments, like, what are the ramifications to the bond market?
Well, so let's put some numbers behind this. So foreign investors own about 30% of outstanding treasuries. And foreign investors, there's a wide swath of investors. We hear a lot about central banks, the Chinese central banks, the Japanese central bank. They've been slowly offloading treasuries for years. So a lot of people see those headlines, they say foreign investors have been selling for a while. And that type of foreign investor has been selling for a while, but the majority of investors who hold treasuries, when I say treasuries, US debt, they're private investors. They're you, they're me, they're hedge funds, they're smaller funds. They're a little more price sensitive, they're a little more nimble. They're not just holding treasuries because they have to for currency offsets, essentially. It's more of a strategic play, for lack of a better phrase. And that means they can let them go quickly. And one other thing that I'll add too is that these private foreign investors have been big buyers over the past several years. So they have been part of the reason why rates have stayed so low, because remember, when you buy bonds, that brings interest rates down. Prices and yields move in opposite directions. So, I think we've taken that for granted. Royal we again. I think the world has taken that for granted, and now we're seeing those private foreign investors start selling off assets, start considering a world outside of treasuries being the only game in town. And the big question is where the bottom is. I don't think this happens quickly, but the worry is that there's a slow drip with no obvious bottom in sight.
What would a crisis in the bond market even look like?
It's hard to say because we've been in this U.S. exceptionalism. Everybody buy treasuries, only game in town.
It's the only thing we kind of know.
Trade for a while.
Yeah.
Yeah. So that's a question that I'm kind of wrestling with myself. I've thought through it, and I think you can make a few basic assumptions here. First of all, money doesn't evaporate. When people sell something, they usually buy something else.
No, I thought it did.
So maybe, I would love to hear your theory behind that. But I think that's an encouraging place to start for investors. Especially if you're looking for where that money is going. It's going somewhere. You just have to figure it out. Earlier on this month, when 10-year yields were whipping around, when the U.S. when the Treasuries trade, when the Treasuries trade was breaking down before our eyes, you saw that money head into European debt. You saw German bonds, you saw Italian yields come down, you saw Swiss yields come down. There was a clear flight into quality European debt. Will that happen in the future? I'm not sure. Nobody knows. But that at least tells you that maybe that's where people are fleeing for safety. And I say fleeing very lightly because I think it's going to be a slow drip. It's not this quick rush for the exits.
As someone managing money and walking people through long-term plans, I imagine in the past 5 years you would always have confidence in the bond market. It's the U.S., man. Like, it's just rock solid. But that has now come into question. How does that change how you build and think about portfolios for the next decade?
I think it's come into question, but I don't think it's breaking down as much as people say it is. And I go back to that slow drip phrase. I mean, there are a lot of things still working for the U.S. here. We have the biggest, brightest, best, most innovative companies. I mean, we still have the deepest and most liquid market out there in treasuries. We have pretty attractive yields at, the 10-year just above 4%. I think there are still a lot of reasons why global investors are looking at treasuries. And at Ritholtz, we're very thoughtful about how we build our portfolios. Fixed income is our all-weather sleeve. And what I mean by that is when stock markets are selling off, we expect our clients to look at their fixed income and say, okay, this is my portfolio cushion. This is where I'm getting my income. I feel like I can breathe through this crisis. And they still feel that way. In a way, bonds are still working. It's just that the 10-year is being especially volatile at the moment. So if you're invested in fixed income, I imagine plenty of people we're talking to are. I wouldn't panic just yet around that. We're still seeing certain parts of the fixed income market work really well. You just have to be really strategic and smart about where you put your money.
The last 2 minutes of the podcast, we always love to get hot takes from guests. Nothing planned. So my question to you is this. What is the next generation, maybe our generation of investors need to do to plan or just, I guess, to ensure their financial safety? And what mistakes do you still see them making today?
That is a really good question. And to some extent, I can't really tell you what's happening in the future. Nobody has a crystal ball. I think the smartest thing you can do right now, and this is an investor of any age, is to set a process. Go back to your why. Why are you investing? Many of us are investing for retirement. We want to be able to live off of our portfolios one day. And if that's your why, then bam, you have a starting point. You know when you're going to, essentially, when you're going to need that money. If you don't know, you could probably back into it. And once you have that, you can make a plan for how much in stocks you hold, which, by the way, stocks are still your best bet at beating inflation. We have piles of historical data showing us that. You still have, fixed income, so many ways to put your money into those portfolio cushions like bonds that you should expect to help you generate income and to cushion you in market sell-offs. Alts and private investments are still very accessible. I think they have a place in portfolios. Obviously, gold has done really well right now. I wouldn't get too crazy. A lot of investors don't need a super complex portfolio, but just know that you still have a lot of agency here, and that's what we're trying to transmit to clients as well. Yes, times feel a little anxious. Yes, markets are selling off, but at the same time, you have the ability to set yourself up for the future and to lean back on a lot of really strong history on how this works.
Is the better play to just buy the market, the SPY, or is it to go look at a company like Nvidia with a powerful driver in AI and hold that for the next 15 years?
I think right now the phrase that people should take away is to not be a hero. I had a good question.
Love that phrase.
Yeah,
it applies.
Yeah, but also like breathe a little bit. It's okay. You don't have to hit a home run in this moment. You just need consistent returns for long enough. I think single stock picking is really, really tough in this environment, especially if you're investing for days, weeks, months, because you're exposed to a lot of headlines, and we've seen some crazy headlines over the past few months. So, if you're an individual investor, you have decades ahead of you. And I want to add too, if you're retired, you also have decades ahead of you, because God forbid you die the day after you
Well, we're all
retire.
living to 200 years old. I mean, I don't know about you, but I am. So
I
I'm going to need a big ass portfolio, Callie. I mean, that's the reality of it.
Right, but even if you're living off your portfolio, know that you probably still need to take some risks for future you. But to get back to your question, you don't have to be a hero here. You don't have to, pick the stock that you think will win. If you want to pick stocks, if you have a thrill from that, if you like to learn, then by all means, it's your money. But just know that, at market bottoms, when a lot of stocks have been hit, maybe some unfairly, it is smarter to, think broadly when you're investing your money.
Real quickly, the morning after Liberation Day, stocks are getting blown up. What was your day like?
Oh my gosh. I tried to blank it from my memory. Well, I was supposed to go into the office. I stayed home because I did not have time to brush my teeth. At Ritholtz, we're always, jamming on what's happening in markets. So there were a lot of conversations going on about that. Of course, we had to make sure that our advisors were in a great spot to talk about what's going on, especially, how it affects our portfolios and ultimately how our clients have invested their money. So I was doing a lot of that. I was doing a lot of processing, a lot of writing, a lot of, talking to advisors and eventually to clients about what was going on. But we have a good story. We tell our clients that bear markets are normal. They knew this would be a possibility, and we guard them against those unexpected scenarios. So we're proud of our clients. We're proud that, we didn't get as many questions as you probably would have thought. Of course, we got questions. Of course, all of us feel anxious about what's going on. But, I feel like that was the time for us to shine, for us to really show why it makes sense to have a partner with your money, and I think we did it well.
So you were a hero.
No, our advisors are our heroes.
All right, good answer. All right, we're going to leave it there. Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Good to see you in person. I love your work.
Yeah, great to be here.
All right, that is it for the latest episode of Opening Bid, sponsored by Vanguard. Continue to hit us with all those 5 stars on all the podcast platforms. Thumbs up on YouTube. Love your comments. You make me better at doing this every single time. I'll talk to you soon.